You sign the papers for a mortgage. Somewhere in the background, a loan officer clicks a few buttons and a number appears in your account. $300,000, maybe more, just sitting there, ready to be wired to a seller you've never met for a house you're about to own. Here's the question almost nobody stops to ask in that moment because the paperwork is stressful enough already. Where did that money actually come from? Did the bank have $300,000 sitting in a vault somewhere, saved up from other people's deposits, just waiting for you to ask for it? The honest answer is stranger than that, and once you understand it, you'll never think about banks, debt, or the word money the same way again. That number in your account didn't come from a vault. It didn't come from someone else's savings account either. In a very real, well-documented sense, it didn't exist anywhere at all until the moment the loan officer approved it. The bank didn't hand you money it already had. It created new money on the spot simply by agreeing to lend it to you. I want to talk about how that actually works today, because it's one of those topics that sounds like it should be a conspiracy theory and turns out instead to be completely mainstream economics, explained openly by central banks themselves, that almost nobody gets taught in school.
Here's where most people's mental model, including mine for a long time, gets it backwards. The story we absorb, usually without ever being explicitly taught it, goes something like this. People deposit money in a bank. The bank keeps a small cushion for safety and lends the rest out to other people. Banks are middlemen, moving existing money from savers to borrowers. It's a tidy, intuitive picture. It's also not really how modern banking works. The actual mechanism, described plainly in explainer material published by major central banks, including the Bank of England, works almost the opposite way around. When a bank approves a loan, it doesn't search its vaults for spare cash to hand over. It simply creates a new deposit, a number in your account, at the exact same moment it records the loan as something you owe them. Two entries appear on the bank's books simultaneously: an asset, the loan you now owe them, and a liability, the deposit now sitting in your account. Nothing physical moved. No existing pile of money got smaller somewhere else to make your loan possible. New money, functionally speaking, just came into existence. This single fact reframes almost everything else in this video, so it's worth sitting with for a second. Loans don't get made from existing deposits. In the modern system, loans create deposits. The lending comes first. The money appears as a direct consequence of that lending decision, not the other way around.
Let's walk through why this actually works, because if banks can just create money by lending it, the obvious question is, what stops them from doing that infinitely? The honest answer is that the real constraint isn't a vault of physical cash at all, it's regulation, specifically capital requirements and reserve requirements set by central banks and financial regulators. A capital requirement says a bank has to hold a certain amount of its own actual capital, its own cushion against losses, relative to the loans it's made. A reserve requirement, where it still applies, requires banks to hold a certain amount of reserves at the central bank relative to their deposits. These rules exist specifically because the system we've just described, banks creating money through lending, is powerful enough that it needs real limits, or it could spiral into instability very quickly. This also explains something that trips a lot of people up. Physical cash, the actual paper bills and coins in circulation, is a tiny fraction of the total money supply in any modern economy. The overwhelming majority of what we call money exists only as entries in bank ledgers, numbers in a database representing IOUs between banks and the people and businesses that use them. When you check your bank balance on an app, you're not looking at a running count of physical currency assigned to you. You're looking at a number that represents what the bank owes you based on a long chain of lending and deposit creation decisions that happened in aggregate across the entire banking system. Central banks play an important role in all of this, but it's more of an indirect one than most people assume. Rather than literally controlling the money supply hour by hour, a central bank primarily sets the price of money, the interest rate at which banks can borrow from each other and from the central bank. Raise that rate, and lending becomes more expensive, which tends to slow down how much new money gets created through the system, because fewer loans get made at a higher cost. Lower it, and the opposite tends to happen. The central bank is less like a factory directly manufacturing money, more like a thermostat, adjusting the conditions under which commercial banks decide how much new money to create through their own lending activity.
Here's the turning point, and it's the part of this that genuinely reshaped how I think about money itself. Money, in this system, isn't a fixed pool of physical stuff that gets divided up and passed around. It's fundamentally a relationship built on trust and bookkeeping, an agreement, backed by regulation and by the shared belief that these numbers mean what everyone agrees they mean. That deposit in your account is really just a promise from your bank that if you ask for it, they'll give it to you, in cash or by transferring it wherever you need it to go. Almost the entire modern economy runs on trillions of these promises, layered on top of each other, almost none of which could be honored simultaneously in physical cash if everyone asked for it all at once. That's not a flaw hiding in the system, waiting to be discovered. It's the system, operating exactly as designed, and it works remarkably well, most of the time, precisely because most people don't ask for physical cash all at once. But it also explains why bank runs, moments when large numbers of people do lose confidence and try to withdraw everything simultaneously, are so dangerous. It's not that the bank did anything secretly wrong, it's that the entire structure was never built to convert every single promise into physical cash at the same moment, because doing so was never actually necessary until suddenly, if trust breaks, it is. This connects to something we've circled around a few times in this series now. Systems built on trust and plausibility, rather than on something physically tangible you can hold in your hand, are remarkably efficient right up until the moment trust itself wavers, and then that same efficiency becomes fragility very quickly. Money, in the modern sense, is one of the largest, most successful examples of exactly that kind of system that exists anywhere in human life.
So what's actually useful here for someone who isn't a central banker or a commercial lender? The most direct benefit is that headlines about interest rates, inflation, and money printing stop being confusing background noise and start making structural sense. When a central bank raises interest rates to fight inflation, it's not turning some dial that directly controls prices. It's making new lending more expensive, which slows down the rate at which new money gets created through the banking system, which, with a lag, tends to cool down demand across the economy. Understanding the mechanism underneath the headline makes the headline itself far easier to actually evaluate, rather than just reacting to. It's also worth understanding that the money sitting in your checking or savings account is, technically, an IOU from your bank, not a stack of cash with your name physically on it somewhere in a vault. That's exactly why deposit insurance exists in most developed countries, a government-backed guarantee that if your bank fails, your deposits, up to a certain limit, are protected anyway. Knowing that this insurance exists and roughly what it covers is genuinely useful, practical financial literacy, not just abstract trivia. And more broadly, it's worth remembering that when you take on debt, whether it's a mortgage, a car loan, or a credit card, you're not simply borrowing a slice of some fixed pool of money that already existed. You're participating directly in the process that creates new money in the economy. That doesn't make debt good or bad in any given situation, but it does make it a genuinely bigger decision than it can sometimes feel like in the moment, both for your own finances and, in aggregate, for the wider system that all of this collective lending quietly builds. What stays with me most about this topic is how completely ordinary the whole mechanism actually is once you see it clearly. There's no secret room full of gold backing all of this. There's no single person deciding how much money should exist today. It's an enormous, distributed system of promises, regulated and monitored, but ultimately running on the same basic ingredient as almost everything else we've talked about in this series: a shared, collective willingness to trust that the numbers mean what we've all agreed they mean. That might sound unsettling at first, the idea that so much of modern life rests on something as abstract as trust in a ledger entry, but there's something genuinely remarkable in it too. This system, imperfect and occasionally fragile as it is, has allowed an almost unimaginable amount of economic activity, building, lending, investing, creating, to happen at a scale that a purely physical gold in a vault system never could have supported. The abstraction isn't a bug. It's most of what makes the modern economy possible at all. You don't need to become a monetary economist to carry something useful from this. You just need to remember the next time you see a number appear in your account, whether from a paycheck, a loan, or anything else, that the number itself is real in every way that matters practically, even though it was never physically sitting anywhere waiting for you. Money was never really the thing. It was always the agreement. Progress beats perfection here, too, in its own way. You don't have to understand every regulatory detail of the banking system. You just have to know, the next time headlines talk about interest rates or inflation, that there's a real, understandable mechanism underneath it, not just noise.
If this genuinely changed how you think about that number in your bank account, that's exactly the kind of thing this channel exists for. I'm Business Decoded, and if you want more of this, the real mechanics behind systems most of us were never actually taught, subscribing genuinely helps. Thanks for watching, and I'll see you in the next one.